The preparation of consolidated financial statements is one of the most important areas of IFRS financial reporting because many modern businesses operate through corporate groups rather than as individual legal entities. Under IFRS 10 consolidated financial statements, a parent company is required to present the assets, liabilities, equity, income, expenses, and cash flows of itself and its subsidiaries as though they constitute a single economic entity. In addition, IAS 28 investments in associates and joint ventures requires investments over which significant influence exists to be accounted for using the equity method. Consolidation therefore reflects the economic substance of group control rather than the legal separation of individual companies and provides stakeholders with a comprehensive picture of the financial position and performance of the group. Consolidated Statement of Financial Position. The Consolidated Statement of Financial Position combines the parent and subsidiary financial statements on a line-by-line basis, eliminating the parent's investment in the subsidiary against the subsidiary's equity at the acquisition date. The principal steps in preparing a consolidated statement of financial position include: combine the assets and liabilities of the parent and subsidiary, eliminate the parent's investment in the subsidiary, calculate and recognize goodwill or bargain purchase gain, separate pre-acquisition and post-acquisition reserves, calculate and present the non-controlling interest, NCI, eliminate intragroup balances and unrealized profits, and include investments in associates using the equity method. The objective is to present financial information as though the group operates as a single reporting entity. Pre-acquisition and post-acquisition profits. An essential principle of consolidation is distinguishing between pre-acquisition and post-acquisition profits. Pre-acquisition profits represent reserves existing within the subsidiary before the parent obtained control. These reserves are regarded as part of the subsidiary's identifiable net assets acquired and therefore contribute to the calculation of goodwill. Post-acquisition profits arise after control has been obtained and belong to the group according to ownership interests. The parent's share of post-acquisition profits increases consolidated retained earnings, while the non-controlling interest receives its proportionate share where ownership is less than 100%. This distinction ensures that only profits earned during the period of group ownership contribute to consolidated reserves. Consolidated goodwill. Under IFRS 3 business combinations, goodwill represents the future economic benefits arising from assets that cannot be individually identified and separately recognized. Goodwill is calculated as fair value of consideration transferred, fair value of non-controlling interest, minus fair value of identifiable net assets acquired. Positive goodwill reflects expected future synergies, customer relationships, management expertise, and other intangible benefits arising from the acquisition. Following acquisition, goodwill is recognized as an intangible asset within the consolidated statement of financial position and is not amortized. Instead, it undergoes annual impairment testing under IAS 36 to ensure that its carrying amount does not exceed recoverable amount. Any impairment loss is recognized immediately in profit or loss and cannot subsequently be reversed. Non-controlling interest, NCI. A non-controlling interest represents the portion of subsidiary equity attributable to shareholders outside the parent group. Although the parent may own less than 100% of the subsidiary shares, IFRS 10 requires 100% of subsidiary assets and liabilities to be consolidated because control exists over the entire business. The NCI is presented separately within equity in the consolidated statement of financial position. Its balance comprises fair value or proportionate share of identifiable net assets at acquisition, and the NCI's share of post-acquisition retained earnings and other reserves. This presentation recognizes that part of the subsidiary's net assets belongs to external shareholders rather than the parent company. Associate accounting under the equity method. An associate is an entity over which the investor exercises significant influence but not control, normally indicated by ownership of between 20% and 50% of voting rights. Unlike subsidiaries, associates are not consolidated line by line. Instead, IAS 28 requires application of the equity method. The investment is initially recognized at cost and subsequently adjusted for the investor's share of post-acquisition profits or losses, other comprehensive income, dividends received, and impairment losses where applicable. The consolidated statement of financial position therefore presents a single investment in associate balance, representing the carrying amount of the investment after post-acquisition adjustments. This treatment reflects significant influence while recognizing that control does not exist. Consolidated statement of profit or loss. The consolidated statement of profit or loss presents the income and expenses of the parent and subsidiaries as though generated by one economic entity. Revenue, cost of sales, operating expenses, finance costs, and taxation are combined line by line after eliminating intragroup transactions. Where a subsidiary is acquired during the reporting period, only post-acquisition income and expenses are included in consolidation because the parent controls the subsidiary only from the acquisition date. Similarly, where a subsidiary is disposed of during the reporting period, consolidation ceases from the disposal date, and only results generated while control existed are included. The parent's share of subsidiary profits contributes to consolidated retained earnings, while the non-controlling interest receives its proportionate allocation of subsidiary profit after tax. Consolidated Statement of Profit or Loss and Other Comprehensive Income. The Consolidated Statement of Profit or Loss and Other Comprehensive Income, OCI, extends traditional profit reporting by including items recognized outside profit or loss under IFRS accounting standards. Typical OCI items include revaluation gains, foreign currency translation differences, fair value movements on FOCI investments, pension remeasurements. Total comprehensive income is allocated between owners of the parent and non-controlling interests. This allocation ensures that all changes in group equity arising from non-owner transactions are appropriately attributed to controlling and non-controlling shareholders. Financial reporting significance. Consolidated financial statements provide stakeholders with a comprehensive representation of the financial position and performance of corporate groups by applying the single economic entity concept. The preparation of consolidated statements requires careful treatment of goodwill, pre- and post-acquisition profits, non-controlling interests, intragroup eliminations, acquisitions, disposals, and associate investments accounted for using the equity method. By applying the principles established in IFRS 10, IFRS 3, and IAS 28, consolidated financial statements faithfully represent the economic substance of group structures and provide investors, lenders, and regulators with relevant, comparable, and transparent information for evaluating corporate performance and financial position.